The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for joining us for this fund update with Ted Franks, the Portfolio Manager of the Pengana WHEB Sustainable Impact Fund. Ted will be joined by Seb Bilo, the Head of Research at WHEB, and George Latham, the Managing Partner and Chief Risk Officer. George is also the architect of the strategy, which is implemented in the fund. My name is Adam Myers, and I lead the distribution team at Pengana. To give a quick introduction to anyone who's not familiar with Pengana, we offer a diverse range of investment strategies run by carefully selected teams who are based either in Australia or offshore. WHEB are based in London, so it's first thing in the morning for them. During the presentation, if you have any questions, please enter them in the question box on the top right-hand corner of your screen, and we'll get to as many as possible in the Q&A at the end. Please note the disclaimer, and now, George, over to you.
Thank you, Adam. And good morning, everybody, and welcome to this webinar, or good afternoon to all of you, rather, in Australia. We're going to take you through. I'm going to give you a brief introduction to the strategy now, and then I'm going to hand over to Seb Bilo, our Head of Research, who's going to talk through the macro elements of the strategy in the current environment. And then the main presentation is going to be given by Ted Franks, Portfolio Manager, on the strategy performance and positioning in the current environment. So to just take you through a brief introduction to WHEB, if I can just move the slide. There we go. So for those of you who aren't familiar with WHEB Asset Management, we are a London-based fund manager that has been running this strategy in the current structure since 2009. We are known as a pioneer in the world of impact investing. We were the first to launch a multi-thematic positive impact strategy back in the early 2000s, and then we're the first to be recognized by the Global Impact Investing Network in 2012 as a listed equity fund that is focused on impact investing. And we've been known for our thought leadership and our approach to reporting on impact investing, which we've developed over the years. And some of you will be familiar with the impact microsite on our website, the impact calculator, which is also available on Pengana's website as well. And we're delighted to have this partnership with Pengana for the Australian market. Just moving on to the next slide, you will see that also the fund is and the business has been recognized very much with a number of awards and recognition, particularly in the Australian market. We're very pleased to be highly recommended by Lonsec and also on the Zenith approved list as well. There are multiple awards there that you'll see, particularly around our approach to sustainable investing and impact investing. The WHEB strategy, just moving on to slide 6, the WHEB strategy is focused around our macroeconomic thesis over the long term. It is our view that the world is in the early stages of a major economic and industrial transition towards a zero carbon and more sustainable economy. And that transition, that major shift in the shape of the global economy, is going to change the shape of all industries and have a very dramatic effect on the market positioning or the market environment that all companies operate in. And that will create winners and losers. And it's our ambition, our objective, to align our clients' investments and our portfolio with companies which are enabling and benefiting from that transition, and at the same time protecting our clients' investments from companies which sit on the wrong side of that transition. And that is why, on the next slide, you'll see that the themes that we invest in, 5 environmental themes and 4 social themes, which are entirely focused around businesses where the product or service that business generates revenue from is solving a sustainability challenge. So they are the company, every time it sells another unit of production, is having a positive impact on society or the environment around them. This is explained in slightly more detail, or in a slightly more granular way, on slide 8, where we talk about business activity in the market in relation to positive and negative externalities. Just to be clear, the 80% of activity or so that's on the left-hand side, the left-hand 2 categories on this slide, labeled as business at risk and growth at risk, are the parts of the market that we don't invest in. We only invest in the companies on the right-hand side of this spectrum that we've labeled as sustainable growth. Because businesses where the product or service is actively creating environmental or social harm, we see as businesses which face an existential threat to their long-term future, and businesses that are in the grip of the transition that need to fundamentally change the shape of the way that they source and manufacture and distribute their product, will see a break or a threat to their long-term growth or a threat to their long-term profitability. So we're looking for businesses such as DSM in nutritional science, AUTODESK in environmental services, or TPI Composites, which makes wind turbine blades, where every time they sell another unit of production, that leads to a positive impact on either society or the environment. And that creates a positive dynamic in relation to growth. That is why we see a demand pull as we see that transition and the shift to a more sustainable and zero carbon economy. So hopefully that gives you a bit of a background for the kinds of companies that we're interested in, where we look to invest. And with that, I'll hand over to Seb, who's going to bring it down to the near term and what that means in the current environment. Seb.
Great, thank you very much, George. Good morning, good afternoon, everybody. So I'm going to talk about COVID and sustainability. Obviously, this is an enormous topic. We're having a health pandemic in the middle of a climate crisis. So there's an awful lot to cover, and I'm not going to try and cover everything. Plus, I think we have a rather mixed audience on the line this evening. So it's going to be quite high level, but I want to give you a sense of how we think coronavirus and the experience that we're all going through with coronavirus is feeding into sustainability. So just turning to the next slide, one of the things which I think is worth bearing in mind is this idea that a crisis is also an opportunity. This is obviously a quote from JFK, who had more than his fair share, perhaps, of crises, most notably with the Cuban Missile Crisis, which I won't go into the detail of that, but actually in many ways ultimately led to a thawing of relationships between the Soviets and the US at that time. And I think the key point here is to recognize and be aware of risk, but also to orientate oneself towards the opportunities that are emerging. Now, clearly, COVID-19 and coronavirus is an enormous challenge to the world and is a personal tragedy for tens of thousands, if not hundreds of thousands of people who have been directly affected. But the disruption that's been created by the world's response to the virus has also created space for a new way of operating, and has also, I think, shifted people's perception of what is valuable and what works. And I think a good example of this is being revealed to us in the healthcare system in the US. Just as an example of this, the crisis has really swept away a lot of dogma that had existed in the US approach to healthcare, and has accelerated the deployment of a wide range of new technologies to help cope with the threat. So, for example, we're seeing massively increased use of telehealth and telemedicine, where we're seeing remote clinical observation and tracking of patients. For example, patient temperatures, blood pressure, all being done remotely. We're seeing the use of predictive analytics that are being used to help predict where vulnerable populations are likely to be, and designing healthcare interventions before those populations get hit with the virus. We're seeing more self-service diagnostics and so on. And perhaps most remarkably, in the US, we've actually seen the US healthcare industry operate more as a system, actually, where you're seeing more information transfer and sharing of best practices, both around diagnosing and treating the disease, but also increasingly around predicting and prevention of the disease itself. Trump himself, who is no fan of a coordinated healthcare system in the US, has said that he believes that the US healthcare system is fundamentally changed. So the genie really is out of the bottle here. And while it's not clear exactly how all this is going to land in the end, there is no question at all that there will be no back to normal. Healthcare, as I said, is the most obviously hit. We're already seeing these changes taking place in the US healthcare system, but other sectors will also be massively changed, and I'll come and speak to those a bit more a little bit later. So just turning to the next slide. For many people, though, the immediate question is just how bad economically will this be? Will it be a severe recession, or will it be more of a sustained and damaging depression like we saw in the 1930s? Here are several economic forecasts that have been issued looking at US GDP and the impact on US GDP ranging from around 3% to over 10%. We've seen several forecasts recently focusing on around the 7% level. So while we think there is still a meaningful chance of a even more severe impact, to a double-digit impact, the chances, I think, of those worst-case scenarios playing out have been meaningfully reduced by the scale of the government response. If we could just move to the next slide, please. The scale of the fiscal stimulus is unparalleled, actually, in peacetime. In the UK, in the US, and also in Japan, we've seen packages of representing more than 10% of domestic GDP, over $2 trillion in the US, somewhat less in other countries in Europe and across Asia as well. But there's no doubt that the overall scale of this response has helped to calm financial markets and ward off the more extreme scenarios that people have talked about. We've also seen governments flex their muscles in other ways as well. And on the next slide, you can see a number of iconic public spaces around the world, which are usually thronged with people, full of people, and they've simply been abandoned as governments have been able to enact these drastic measures around social distancing and lockdowns. And I think the point here is that if we can see governments acting with such boldness on this agenda, then why shouldn't they also feel as bold when it comes to when people realize the scale of the climate change and wider sustainability challenges? At the same time, and perhaps more profoundly, on the next slide, the role that individuals have played as well has been quite extraordinary, I think. Partly the motivation for this, I think, is around concerns about our own safety and the safety of our close family members. But a big part is also driven by the desire to protect others. Here in the UK, the mantra that the government use is stay home, protect the National Health Service, and save lives. And I think there is a deeper cultural change that is taking place, where acting in what is perceived to be an irresponsible manner has become socially unacceptable. And clearly there are parallels, I think, with this, with the coronavirus, and also with the personal and collective action that is needed to address climate change. So if we now turn to some of the more specific changes that we've seen that might have implications for us as investors, Ted will pick up on some of these points a bit later, and I'm not trying to be comprehensive here, but just picking up on three areas where we think there have been major social changes which we think will endure after the virus has passed. And first of all, focusing on how consumers, how governments, and particularly how companies think about resilience. I think it's most marked in the food supply chains at the moment, which have come under such pressure over the last month or so. But I think we'll see it elsewhere as well. The importance of resilience will remain long after the crisis is overcome, and I think we'll see businesses evolve their business models and their supply chains to become more resilient to these kinds of shocks. The second area is clearly air travel. We've seen a collapse in the amount of air travel around the world. We had a story in the UK press a couple of days ago about the cost of air travel is likely to double after the crisis. We've discovered that you can give video conferences to people thousands of miles away in your boxer shorts, and it's a lot better than having to fly there. Only joking. But even the CEO of Lufthansa has said that he believes the era of more than 5% annual growth in air travel is over forever. So I think that's another sector that's clearly the impacts are going to endure. And then finally, also the power of online. I mean, it's been remarkable to see the growth in online shopping. Of course, this was an existing trend, but it's been massively accelerated by lockdown in countries around the world. Amazon, I think, announced yesterday or the day before yesterday that they're recruiting another 75,000 people. And while resilience in air travel are likely to be good news, actually, for sustainability, the acceleration in online retail is likely to be much less so. But it is clearly part of the new paradigm. And then finally, before I hand over to Ted, what is critical is how we respond to the crisis as we come out of the crisis and the stimulus packages after the crisis. If we could just move forward, that's it, the next slide. How countries choose to deploy their packages to stimulate their economies is going to be absolutely critical. We've seen here in the UK and also in the EU some very promising signs from leading policymakers, from companies as well in the EU, saying how they very much want to see a green recovery as part of that stimulus. It's obviously a more mixed picture in other parts of the world, in the US, for example, where there are very different narratives emerging around what that stimulus should focus on. We're clearly hoping to see as much support for the green infrastructure and green economy as we can, but that's still very much an open question how that's going to play out. So over to Ted.
Great. Thanks, Seb, and good morning, everybody. You'll notice that I'm the only web partner wearing a headset. I'm hoping this is going to screen out the small children as we go through the 3 bits of my part of the presentation. So with Seb setting the scene there in terms of some of the bigger trends and how they may relate to sustainability, what I'm going to talk about is, hold on, should slide, there you go. What I'm going to talk about is the strategy and how it's performed in the first quarter as we've hit the crisis. Then a little bit more about a slightly nearer term view than what Seb was talking about in terms of what are the themes that we can see clearly emerging thus far that we're going to invest in. We're obviously doing lots of work to try and make sure we're on top of the longer term themes. And then just a little bit of detail on the trading we've done in the crisis so far. So starting with the strategy performance so far in the first quarter, in absolute terms, you can see obviously it wasn't a happy quarter. Now this chart with the volatility that's been around and the bounce we've had since, obviously this picture looks better already to a certain extent. But the other point I would make, and you guys are obviously very aware, is that this downdraft comes after a pretty prolonged equity bull market, 10 years or so. And so it's perhaps less painful for some investors than it could otherwise be, but it's still meaningful and different and creates a changed context. The strategy in that period, as you can see here, has roughly kept pace with the MSCI World, which is our benchmark, one of our 2 benchmarks, really, but kind of the more important one. But to dig into that in more detail, although obviously we're always very conscious of absolute performance, really to tell the story, we tell it in relative terms, and we tell it against the MSCI World with an attribution according to those 9 themes that George demonstrated before, and that hasn't advanced. I'll just try and advance it. There you go. So here you can clearly see the positive and negative thematic contributors in the first quarter, and you've got thematic selection effect, resource efficiency, health, and sustainable transport. And I'll just hit the sort of big and more interesting ones as we go through, starting with health. Seb's already talked about the profound impact that COVID is going to have on changing healthcare systems around the world. In the short term, in the first quarter, I guess you can see there are 3 kind of key reasons for a strong contribution from it. Number one, these companies are providing solutions to the COVID challenge. So clearly their actual core business model is certainly not negatively affected. In most cases, there's something positive they're doing. Number two, just a piece of equity market strategy. They're obviously a bit more defensive, so they tend to be a tactical place to hide in times of downturns. And then number three, which is the picture on the right-hand side, this gentleman, Bernie Sanders. This is the only piece of non-COVID relevant performance really in the first quarter, and that was that his challenge for the Democratic leadership in the US, Democratic presidential candidacy in the US, faded in the first quarter. He was providing an overhang to some of our US healthcare stocks because he proposed a fairly radical change to the US healthcare system. Of course, the fascinating thing is that it's possible that COVID will help deliver some of the changes, perhaps as radical in some areas as he was proposing, but I think it's safe to say it will remain within capitalist guidelines, and therefore we feel much less fearful about some potential changes to our stocks there. Then on to the big negative story, which is sustainable transport. Now, sustainable transport for us is couched very much in terms, although there's little bits of getting away from road transport into rail, it's really about this electric vehicle transition, which we're very excited about. And we see the capability for a very meaningful part of the transition to a more sustainable world being delivered by mass adoption of electric vehicles. In the run-up to the crisis, we'd seen a slowing global automotive market, and that had depressed valuations. And with our 5-year lens, and we certainly invest over 5 years in recent years, our turnover implied horizons actually more like 7 years, we could see this being a very interesting investment area. Unfortunately, what COVID has created is a real air pocket in just global automotive demand. So even if our stocks have penetration stories, which mean that even if global growth is flat or negative, they're still going to do sort of 5% positive, and they're very striking outperformance of their market. They're not going to do that if global automotive growth is minus 13% and no one can buy cars for 6 months. So definitely a lot of turbulence here. I think it just mentioned these two themes quickly. Our healthcare theme and the way up to the crisis, for various reasons, partly to do with our take on the market, but really more of a bottom-up basis. The healthcare theme was trading very near the top of our thematic limit, which is 30%. So that's been helpful for us. I think it's fair to say we'd grown enthusiastic about the transition to EVs. So our EV exposure was around 10%, and it's not been helpful in this time. We're doing a lot of work now to try and figure out and handicap exactly what that should be going forward. Now, the other sort of key performance area that I just want to talk about is actually our thematic selection effect. Now, this is a very useful tool for us in a way. It tells you the attribution towards the rest of the index, which isn't included inside our universe. And so in very broad terms, it basically kind of tells you whether investing in sustainability, as we define it, has been a headwind or a tailwind in the period. Although it's slightly imperfect, so we're sort of careful not to get too precise about it. Now, what this means in shorter time periods, such as this first quarter, is that actually a lot of the sector texture that you're seeing in the market is reflected through the thematic selection effect. And so if you look at the left-hand side of this chart, you've got our sector skyline. We don't pick by sectors, we pick by solutions to sustainability challenges, but they fall into those sectors. And you can see it gives us this big overweight in industrials, which is companies which interact with the physical environment. That's very important for environmental investing, and a big overweight in healthcare, but clearly nothing in financials or energy, or very little in consumer services, consumer staples. And then if you go to the right-hand side of the slide, you can just see clearly in this first period, no financials, no energy with the oil price crash, very helpful for us. But perhaps most interesting, and certainly most relevant at the moment for those that are selecting sustainable and ESG funds, is the bottom of the right-hand side there, and the big negative attribution we've had from communication services and information technology. Now, what that means, particularly in the information technology space, is that our approach to information technology is that it's definitely part of the sustainability solution. There's all kinds of important transition tools which are enabled by sustainability, enabled by digitization and technology. What it doesn't mean is that we invest in the vast majority of IT and entertainment IT and consumer IT and sort of e-gaming or any of those electric payments or any of those kinds of stocks which have done very well in the crisis and also been very popular for a number of years previously. And critically, we don't invest in any of the mega cap tech stocks. So no Microsoft, no Amazon, no Apple. We can go into this as a topic for a different webinar, but really what we see them doing is turbocharging the consumption, which is kind of the key challenge to move to a more sustainable environment. So what we do have in information technology, just so you guys are aware, is on the next slide. Clearly, We like industrial application software. We like anyone which is really about computer-aided design and making things more efficient in a very close application setting. We like industrial efficiency in robotics, decarbonising the factory floor. And we're also very interested in the Internet of Things and connectivity, because that's a big part, as we'll come on to later, of making things more sustainable. But this is an important point to understand about the strategy. And clearly in the first quarter, not having the big internet stocks, which have done very, very well, has been a bit of a headwind. And you can see that headwind actually in the next slide as well, although it doesn't explain all of this. This is a slide about size and how size impacts our performance. Our strategy is naturally a mid-cap strategy. And again, this is one of the features of the strategy which isn't deliberate, but what we look for is pure play companies where the equity story is the sustainability story. So if the sustainability story is happening, then the equity is working as well. And for that to be the case, you need those companies really to have, well, we have a minimum of 50%, but the average across the portfolio is kind of 80, 85% or more of the revenues and profits come from providing the solution to sustainability challenges. And then you quickly realize you're into mid caps, because that's where you get the pure play companies. So we do have a fairly significant kind of mid cap bias compared to the global equity market. You can see it's been a tough time for mid caps. Part of that is the outperformance of the mega cap tech stocks. But part of it is also just a sort of risk off kind of flight to defensiveness reaction. And the light blue bars on the right-hand side of this slide are the attribution to the different size pools and our allocation effect, in fact, of how we're spread out. And you can see, because they're all negative, our selection has had to be rather strong to recompense. So in fact, what happened the first quarter effectively was that as mid-cap faded away, the sustainability stories sustained those companies to help them to keep up with the large cap stocks. So that's been positive in this quarter. So then I'm going to move on to, and obviously we'll take any questions on performance. What we're going to move on to next is some of those themes that we talked about, and specifically how they are playing out for us at the moment. And really, with SEB's broader context in mind, the immediate context really where we see particularly interesting areas are kind of under three headings: health, safety, and resilience. We're particularly interested in a way in resilience, which ties very closely to sustainability. And that's also where the more interesting and kind of subtle changes are going to be. And that's where we're doing a lot of our work at the moment. So in terms of health, just giving some specific stock examples, testing clearly front and center of the response to COVID, becoming increasingly important as we try and puzzle out this answer about how the world comes out of a lockdown and how we cope with future pandemic waves. We can talk about testing a long time. There's a lot of aspects about it. Historically, it's tended to be actually more expensive than efficient for most healthcare systems. But at the moment, it's obviously front and center. We've held Danaher, Thermo Fisher, and Agilent, all of them since 2012. They've turned out to be the big winners in the life sciences space. They've all got solutions. I'll talk about Danaher. Danaher's got Sophia, it's got the Expert Express, very rapid turnaround. I think they have a 45-minute SARS test. They've also got IDT, which is producing a primer and probe kit as well, but there's other bits of their business which are part of the testing solution. Clearly, this is going to be not just a medium-term, but a long-term driver. Staying in the health theme, we've got the healthcare systems and their pandemic response. Now, on the right-hand side, not going into detail here, but you've got healthcare IT companies like Cerner and HMS, and they've got some very interesting population health management tools. Premier on the left-hand side here is perhaps our company which has been most in the thick of the COVID response. It's a group purchasing organization. It helps hospital networks source their equipment, including the PPE equipment, which is so critical at the moment, but also all of their medicines and everything they need to buy, including capital equipment. And obviously they've had a critical role in trying to coordinate this response, which has at times been, I think it's fair to say, fairly chaotic. I mean, what's emerged in terms of the global response in terms of PPE has been not particularly impressive. So a big role there for Premier, and it will be increasingly important. Then moving on to the safety and hygiene side, we have a safety theme. It's got lots of emphasis on protecting human life. Actually, the stock that is most interesting to talk about here is in our water management theme, which is Ecolab, which is a chemicals and detergents company with a lot of water applications. Ecolab clearly has got a big role to play now in how the world copes with sanitation rather than sanity, although that's obviously a question as well. How the world copes with sanitation, both in the pandemic moment, but also as we go forward. Fascinating thing about Ecolab is because they have 14% of their business serving the restaurant industry, they initially traded off in this crisis, which we couldn't get our heads around at all. Happily, they've returned to some more sensible position now. I mean, this is a business that actually sells hand sanitizers. clearly there'll be a lot more work for them in the future, and these other companies as well. So then on to resilience, which, as I mentioned before, is an area we think is really, really interesting on the back of the pandemic. We've got just a couple of examples of areas we're currently exposed to, which we think are relevant, but we're looking at this space quite a lot. The first is in supply chains. The pandemic has just detonated supply chains really there at full stretch, and there's all kinds of questions about how they work. As most of you will be aware, for the 2 years before the pandemic, global supply chains were being ripped apart by human hands instead, and particularly the inhabitants of the White House at the moment. Prior to that, there'd been this long period of building up global supply chains. So clearly, people have become accustomed to being able to get hold of high quality goods and services anywhere in the world. So there's a big role for the testing inspection companies. Again, we've owned Intertek since 2012, 8 years invest in this company. We're certainly going to own it for a long time. There's going to be so much more reliance on making sure that your supply chain is safe and secure. And then the other side of resilience, which we can see emerging straight away, is this idea of connectivity and the Internet of Things, effectively. We've got a couple of examples on the right-hand side of the companies which enable it in the sort of analog semiconductor space. Then on the left-hand side, Xylem, which is a maker of pumps and meters, they are on the front foot, pointing out to everybody that the resilient networks they've created, which have minimal human interface and can, as a result, actually be rather sterile, quite a useful sterile aspect to them as well, are enabling a more effective pandemic response. And so I can only see there being more use of systems which allow the human not to have to be in the center of making activities happen. So hopefully that's helpful with a little bit of the more granular stocks and thematic stories that we're thinking about at the moment. We've been through the performance, and that just leaves at the end just to talk about exactly what we've done. And this is by way of really indicating for those that perhaps are newer to the strategy that what we've actually done is not an awful lot, and that sort of fits with us for a couple of reasons. I mean, first of all, a lot of our stocks are actually rather suited to the challenges thrown up by COVID because of their sustainability drivers. So we feel we're kind of in the right place anyway for a lot of the long-term changes. But we are also long-term investors. It's an important part of being an impact investor, and our drivers and our themes play out over multiple years. That said, clearly the market disruption has provided opportunities. In the first wave of trading in March, we saw the opportunity to change our resource efficiency theme around a little bit and go for some slightly more defensive and durable companies which do still have a kind of industrial cyclical angle. We added Autodesk and Silicon Labs. I'll talk about them in a moment. We took out IPG Photonics. Really, with that compression of valuations, there was a real opportunity there to do some of the things we've been thinking about doing for a while. Since the quarter end, we have also sold Nitto Denko within the resource efficiency theme. And just as an indication of what we're currently thinking about, having sort of cleared up some of that stuff on the cyclical side, our big focus now is really around automotive, where our exposure is there. Can we do defensive things outside healthcare? And critically, this big question, what's going to work in a post-COVID world? That's what's really dominating our thinking. And we're hoping that we can get onto ideas we feel good about at a time when the market is still disrupted. But I think we also feel that we don't need to hurry because there will be more market disruption this year. So then the names that we've actually added, Autodesk. We've been fans of Autodesk for a long time. It's been trading at very high valuations before this crisis. Actually, already it's sort of returning, fairly promptly since we bought it. But we've, obviously we have a longer term lens on that. They are the global leader in computer-aided design. They are kind of the incumbent and the original company to do this. They're the largest company in the sector doing it, and they have an R&D budget which is vast, $750 million, broadly a couple of times the size of their competitors. There's a very interesting dynamic going on at the moment where they're trying to popularize the more complex features of that are available in their systems, and they're competing with Dassault Systems and Siemens and PTC to an extent there. But actually, it's such a growing market that the competition side is less important than the fact that there'll be plenty for everybody, and Autodesk will probably win in the end anyway. It's a software as a service model, so it's obviously very cash generative and appealing from that point of view. And then the other one, Silicon Labs. This is an analog semiconductor where you might say that Autodesk has a very high recurring revenue base and therefore will be a bit more defensive through the tribulations of 2020. We actually think that 2020 probably still looks a little bit tough for Silicon Labs, but that doesn't matter because we've got a 5-year conviction in the Internet of Things. So Silicon Labs makes low power radio frequency microchips, so you can put them inside objects which don't have a power supply and connect them to the internet. So that's the core of the Internet of Things. They've got a very strong IP leadership in that space. We really like the management style. We like the culture. It's a company, one of the companies based out in Austin, Texas, with a very thoughtful management team. Again, it's been very expensive for a while. We've seen an opportunity here and we started a position. So I can round things up here before we go to questions. The headlines really on the next slide, which, there you go, is that we think a pandemic-aware world favours solutions providers, it favours resilient companies, it favours future-proof businesses. I should be careful, you know, we can definitely see some of the challenges which are coming as the world is transformed, but broadly speaking, we think the portfolio is in the right place now, and we think there are lots of interesting opportunities to come. So with that, we'll go to questions, and thank you for listening.
Thanks, everyone. We've received a number of questions, which some of them I've grouped into themes, but I will go through them as efficiently as possible. Ted, over the last few weeks, what changes have you made to the portfolio from a defensive or de-risking perspective?
Yes, thanks, Adam. I mean, I think as I mentioned, you know, we went into the so we have the 9 themes. Now we have 2 larger themes, which are health and resource efficiency. We have a risk management rule, which is that no single theme should run above 30% from a sort of diversification point of view. And the health theme, actually, I mean, we're not macro pickers, we're very much bottom up led. And I certainly am not going to claim that we saw this coming by any stretch. But the health theme was up above 29% for a reason, and that has turned out to be correct. Of course, as a long-term investor in cyclical trends with underlying secular trends, we try not to get too sucked into trying to be too defensive, because we're trying to give people sustainability in its broadest context, right? But we were already kind of there on the health theme, so that gives us little bits of defensiveness around the other themes, and particularly kind of safety, well-being, education. They might have more qualities to them. The answer is we haven't really yet done an awful lot. In well-being, we've taken Cooper companies up a little bit. We've trimmed some of the other more cyclical names a bit more. We're looking now at some of the names in education which we had on the shelf, but that's really this phase now. And I think the very interesting thing, just the sort of final point of this, is what is clear as we discuss V, L, U, W, whatever shape recovery people want, and we're moving towards the bearish side. What is clear is that the exit from lockdown is going to be difficult, and you know, even with a 5-year view, we need to make sure we have conviction in some of our cyclical names. So that's the answer. We're kind of as defensive as we easily could have been. We're looking to add a little bit more. We haven't done that much in the last few weeks because, again, we're careful not to go too nuts with it.
Okay, thank you. 2 more questions about sustainable transport. The first is, and Seb, I'm going to direct this one to you. What is the rationale in investing in electric vehicles, given that they are powered by coal-fired power stations? That's primarily in Australia. The materials for the batteries are mining intensive, and environmentally friendly disposal is an ongoing issue.
Okay, well, I mean, the biggest impact associated with transport, with vehicles, is the use phase. So the manufacturing, actually, you know, if we look at just greenhouse gas emissions associated with the life cycle of a car, over 80% of the impact is in the use phase. It uses a lot of energy to use a car. So while there are these other impacts that we need to be aware of in the value chain around mining, for example, from a greenhouse gas point of view, actually, it's really all about the use phase. So the question about the coal-fired power station is really the most important part at least from a greenhouse gas point of view. And actually, I mean, there are many studies on this. I think that the 2 key messages are, first of all, grids all around the world are getting greener everywhere, even Australia. So as the clock rolls forward, the benefits associated with electric vehicles, battery electric vehicles, compared to internal combustion engines get better. In the UK, we've seen this extraordinary shift to renewable energy, and we expect that that'll happen elsewhere as well. So that's the first point. The second point is actually some studies will even say that if you're using nothing but coal-fired power stations, you're still better off with electric vehicles. The efficiencies are so much better that even with coal-fired power stations, you're better with battery electric vehicles. They don't all say that, so I think you probably have to be a bit cautious. But generally, there's the argument about whether battery electric vehicles are better than internal combustion engine vehicles is over. It's clear that battery electric vehicles are better at least from a greenhouse gas point of view. There are other issues, of course, but on that key topic, they are superior. So that's why we're interested in them.
Fantastic. Ted, sticking with sustainable transport, sustainable transport stocks have been hard hit by a combination of trade tensions and now obviously COVID-19. Does the sector represent deep value at this stage, and what do you expect the implications of the current turmoil in the automotive market to be for the transition to electric vehicles?
Yeah. I mean, and this is a huge question. Does it represent deep value? Yes, and we've thought that really since, I mean, certainly since 2018, I guess we started to see some real indications of that. The valuations of that sector have been low for a long time. Remember, our strategy has a kind of style bias, which is a bit more of a quality bias because we're longer term. But really, we're really driven by impact and sustainability, and we just kind of go where we see the impact happening. That's what leads us in. So if we see a very impactful sector and it happens to be a deep value play, then we try and play it on a deep value basis. Luckily, as long-term investors, that makes sense for us. This is very interesting, though, because whilst we were all sort of watching the trade tensions, watching the supply chains change, watching the adoption rates of electric vehicles, as an anecdote, and you always got to try and avoid anecdotes. I know that, but I did myself buy, I should say, an old electric vehicle recently, a Renault Zoe from 2013, bless it. And just in terms of my personal experience of it in London, I was like, it's just so good. It's really so good. It's such a good experience, which makes you very confident that transition will be very quick. The question now is, what happens in that transition? And there's this very interesting, Tesla again becomes the crucible of this. And we've not been Tesla investors because it certainly hasn't represented deep value, but they don't have the legacy assets in internal combustion engine to cope with. So they are, unfortunately, as someone who's not invested in them, probably in a slightly stronger position here. What happens to the big OEMs? Do they abandon altogether their ICE programs, which would potentially be more cash generative? Do they just swing for the bleachers, as the Americans would say, and try to go into EVs? My suspicion is that they will. The announcements they've made thus far, I mean, most crucially from VW, is that they are sticking with their program. They're sticking with their dates and timelines. They're encouraging governments around the world to stick with their emission standards reduction targets. So it does feel to us as though on balance we come back more rapidly in an EV world, but you can imagine that a fund manager with 10% exposure to this theme is spending a lot of time trying to figure this out.
Fantastic. Thank you very much. George, do you think ESG and impact funds will see increased inflows during and after this crisis?
It's a very good question. There's always been a sort of a claim, a sense that that sustainable investors or clients of sustainability funds should be stickier clients, should represent, have a longer term view in the way that they invest. Having been involved in sustainable investment funds through both the last two crises, the sort of the tech bubble in the early 2000s and the global financial crisis in 2008, 2009, that proved true that sustainability funds, SRI funds, ESG funds, sustained inflows through those crises and didn't see the significant outflows, and that's so far holding true for us today, and I think probably for sustainability funds in general, that we've seen consistent inflows into the fund in January, February and March this year. What's interesting, I think, is that both the last two bubbles, or both the last two major market cycles, the tech bubble in 2000, 2001, and the global financial crisis, were coincident with clean energy bubbles. Some may remember Ballard Power, a Canadian-based fuel cell company that was really caught up in the hype of the tech bubble in the late 90s. Was a multi-billion-dollar stock and burst fairly spectacularly in the aftermath of that. The bursting of the tech bubble and the sort of clean tech bubble in 2008, 2009 both set back, I think, the agenda, the financial, the investment industry in relation to sustainability for some years, because people, there were very concentrated asset bubbles at that time. What we've seen today is very different, is that actually we're seeing sustainability funds proving, I think, more resilient in some places than the market, in the teeth of the sort of market falls, and a number of investors looking to sustainability as potentially being a route out of the crisis. So it feels different this time round.
Thank you. That was a very comprehensive answer. An interesting question here goes to goes to the heart of the strategy. Why do you feel that Alphabet is growth at risk? Ted, perhaps you can address that.
Alphabet and Google, why is its growth at risk?
Why do you categorize it as growth at risk?
I guess this is a question which obviously we spend quite a lot of time thinking about, and if it's okay, I can give an answer to it, which is my best explanation. But I think people should understand our approach is to try and invest in companies which are solutions to sustainability challenges. That's the core of what we're trying to do. We're doing it because we have a conviction that this is the next wave of industrial growth, and this is where the world is transitioning to. Now, if there are other areas other than sustainability which do have growth in, that's fine, really. We think over the long term, sustainability is the superior growth area, but the strategy is not just a global growth strategy, right? So it's not because Alphabet's growth is at risk. That's not the reason. The reason we don't invest in Google is that what it does is it monetizes advertising and effectively drives consumption, and has managed amazingly to monopolize advertising, which has been very, very powerful for it, as it has for all the internet stocks. Just to be completely clear about it, it's because it's not a solution. That's why we don't invest in it, not because we think it hasn't got a growth prospects. We think its growth prospects are pretty strong. Clearly, they've been very strong for a while. For it to undo, you obviously need either some sort of pricing issue which encourages competition to emerge. But the very interesting thing about the global mega cap tech stocks is that the competition authorities have been so asleep at the wheel and just not known how to foster the kind of competition that clearly the world needed for some of these products to provide even lower cost to the users. And the other thing, of course, is that at some point they will run into regulatory buffers of one or other sort. So I can't tell you exactly at what point Alphabet's growth becomes at risk. I can see the areas where they might come from risk, but just to be 100% clear, we're not saying we don't invest in them because we think they're about to crash. It's just they're not a solution to sustainability challenge. And in fact, again, probably a topic for another webinar, what they've done in terms of turbocharging consumption, at best neutral, you might say. So that's the position there.
Okay, thank you very much. The next question is, sorry, there are so many, I'm just trying to make sense of them. What proportion of the portfolio companies are providing information which is being used as inputs to your impact calculator?
Excellent, thank you very much. Very specific question, and very much top of mind for me at the moment, as I'm in the throes of crunching this information with my wonderful colleague Katie Woodhouse. So last year, there's a good story here actually. Last year and in 2017, for the 2017 report and the 2018 report, 40% of portfolio companies were reporting data that we could use directly in our impact report. This year, I can't remember the precise number, but I think it's more like 56% of companies are actually reporting data that we can use in the impact report. So we have seen a significant increase, which is fantastic. I'd like to think that's down to our engagement. It's probably not completely down to our engagement, but I think that has played a role. But that doesn't mean that the data covers all the companies. There are a few companies that are now reporting limited data around, for example, a portion of their product set, and we use that information recognizing that there's still more data that those companies need to produce. But it's gone from 40 to over 50% this year, so a way to go still, but definitely moving in the right direction.
Great. Has anything about the current COVID-19 crisis really highlighted the value of sustainable or impact investing?
Shall I have a stab at that?
Yeah, go for it. Sorry.
Well, I think there are a couple of things that that we would point to. The first was something that Ted mentioned in his presentation, and this idea around, for us, sustainable investing is really about solution providers, companies who are making and selling products and services that are directly addressing critical social and environmental challenges. And one of those areas has always been health for us. It's one of our big themes, as Ted has mentioned. A focus on solution providers in the health area is clearly exactly where we're seeing a response to the COVID pandemic. So there's a natural focus on solution providers within sustainability strategies, which I think is relevant. And then the other slightly more sort of esoteric point, but I think also important, is we're seeing demands or being put on companies to behave in a way which is sort of recognizes the broader role that companies have in society. They're not just money-making machines. They have a broader role, and I think companies that recognize and understand sustainability tend to have that broader perspective and a clearer understanding of their responsibilities, not just to their investors, but also to their customers, to the communities in which they exist, to their employees. Well, I wouldn't want to overplay this. I do think there is a there is a qualitative difference, at least in the kind of perspective that more sustainable companies have on that agenda, which I think is useful.
Seb, that leads really well into the next question, which is, have any of your investee companies had any issues with, or have there been any issues with how they've handled their workforce through this crisis? Have the employers been supportive? Have there been massive layoffs, etc.?
So we've been in touch with nearly half, I guess, of the companies, and we've obviously watched what they've produced in terms of their comments. And thus far, I've been very impressed. I mean, I think it's fair to say, after an early bit of confusion, which I think everybody had as we sort of got our heads around the scale of this problem, leadership has quickly resolved that the thing to do is the right thing, as it were. And certainly, we're not aware of anyone who's done anything wrong or that we didn't like from an employment point of view. We do have a couple of examples that we perhaps were slightly surprised at. I mean, JB Hunt is an American logistics company we invest in because it's a leader in intermodal transport, which takes freight off the road and puts it onto rail. That's a decarbonisation angle to that story, though we've got to think about that company now because there are real questions for freight and obviously energy prices. But those guys, they're red in tooth and claw, and they came out. They've been super supportive of their workforce, been very impressed. There've been bonuses for the people who've been working hard. They might have been, they're American, so they might have been, the American mode, of course, is to let people go quickly and then rehire them quickly. And for the rest of our companies, I think they've all been very good, really. Seb, I just looking at you.
I was going to say the same. The only thing that we're very attentive to is we're coming up for AGM season, a lot of voting at AGMs over the next couple of months. We've seen most of our companies withdraw their dividends, which we think is, for many is an appropriate response. We will be watching remuneration packages over this season. I mean, we always do, but I think it would be, in many cases, it would be deeply inappropriate to be taking significant bonuses home as a management team if you're having to furlough your employees or and if you're receiving government support in some way, to immediately pay that out as a big bonus would be deeply problematic, we think. So we'll be watching that pretty closely. We've not seen anything egregious yet, but as I say, most of that is happening over the next couple of months.
Great. I think we've got time for a couple more. What kind of water stocks do you see as the best? Do you see as the best prospects at the moment, and does this extend to water-dependent investors like the irrigation sector?
Yes. So the water theme is interesting, isn't it? I mean, well, it's always interesting. So broadly, when you think about water, an investment in the universe, you think about two categories. There's water utilities, and then there's industrial water. And we have traditionally preferred industrial water because we think those companies are actually the change agents. These are the companies who make the pumps and the valves and the meters and those sorts of things. And they're actually really working on actual solutions. The utilities, of course, are a big part of delivering solutions, but most of them are regulated. So really what they're doing is working in concert with regulators to deliver those solutions rather than being the change agents themselves. Then you've got this equity strategy overlay on top of that, which is to say that the utilities companies do trade as bond proxies, which has been a very positive place to be for the last number of years, just from a low interest rate environment, kind of unrelated to sustainability angle. But the good news is, even whilst that's been a very strong tailwind for the utilities, the industrial water sector has done very well as well. And, you know, Seb said, this is a pandemic in the middle of a climate crisis. Now, I'm not, as a man from the north of England, going to talk to Australians about a lack of rain, but I did speak to my father last night. He's been keeping records in his garden for nearly a decade now. February in the UK was his single wettest month in a decade. April is by far going to be his driest month in a decade. Those climate changes are so profound. Again, I don't need to tell Australians about it, that don't worry too much about the pandemic, because the big picture in terms of global water use is going to continue to be very compelling. The final point, and I appreciate it's a long answer, is what comes with that is the world is onto this. They know that water stocks are interesting, and what's always held us back to a certain extent has been valuation. We've had Xylem, which we've invested in. We thought it was way ahead in terms of digitization. We've been right. It's performed very, very well. It's always seemed expensive. We've always had a valuation question about Xylem. In terms of straightforward irrigation stocks in our kind of larger cap space, there's a couple, Valmont and Lindsay. They're not really solutions providers so much as servicing the American big sort of center pivot systems, which have a sustainability question to them. So we've never really found a great irrigation answer that we really like ourselves in our kind of mid-cap space. And I've stopped talking now because that's a massively long answer, but I hope that was useful, whoever asked the question.
Thank you. Seb, one last question, quite briefly, because we are running out of time.
Sorry.
What can the asset management industry do to help maintain momentum around the green agenda if governments are distracted about all of this in the post-COVID world?
Yeah, I think there's a few things that we can do, and actually the PRI have been quite helpful in sort of setting out the agenda here. I mean, I've talked about engaging companies through AGMs. I think that's something that we will continue to do, and there's a sustainability message to a lot of our engagement. So that's you know, perhaps more important at this moment to kind of keep companies on that course. And I think there's a big policy role for investors as well, whether that's through the PRI, like I say, they're organising some events to encourage investors to engage and be assertive in the policy agenda and making sure that green recovery is part of the recovery. And also, you know, organisations like the IGCC in Europe, I think it's the IGCC in Australia, specifically focused on climate and policy. So we need investors to really step up and put their shoulders to the wheel there and make sure that that message that investors want to see a green recovery is clearly made and repeatedly made to policymakers.
Great, thank you very much. Ladies and gentlemen, thank you for joining us for this update today. Our hour is up, so I'm going to wrap it up. I hope you found it useful. My key takeaways are that there are undoubtedly going to be long-term changes from the COVID crisis, but crises do present opportunities, both from a sustainability perspective and significantly from an investment perspective as well. And the team remain focused on finding these opportunities within their 9 sustainability themes. A recording of this webinar will be available online at pengana.com/webinar. We were unfortunately not able to cover all the questions today, but for any left unanswered, we'll make sure that a member of our team gets in contact with you directly. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much.
Thank you.